Hi, welcome back again to Tim Bigham's Options and Volatility newsletter. We'll be taking a look today once again at why implied volatility, IV, matters. In this case, unusual option activity in Virgin Galactic Holdings, SPCE, post-earnings, as the stock ripping higher post-earnings, even though it didn't rip higher the day earnings came out, but the day after. Maybe some short interest having to do with that, as we're seeing some of these stocks with big short interest get a little of that meme mania back, but how we can take advantage of this huge spike in IV to position to capture that vol. So let's jump in and take a look. First, here's one of the scanners. This is the one I built on the Thinkorswim platform, showing SPCE. Here's that big unusual option activity. My scanner basically highlights unusual option activity with a lift in implied volatility. I think you need to have that lift in IV to make it a meaningful edge here. So you can see space, some big call buying here, certainly over 3,000 contracts of the May 25 calls, the June 5 calls, and the June, a little bit later, $7 calls. So seeing big unusual option activity. Also, a different scanner I use here. Number one on the list was Virgin Galactic Holdings, as we can see here highlighted in yellow. Over 280,000 option contracts traded versus average volume of just over 10,000. So that relative volume, over 25 times more volume. Again, this is post-earnings, right? This was from Friday. Earnings came out May 15th, Thursday, after the close, right? So you saw the stock ripping higher here, but you saw implied volatility jumping by over 80% post-earnings. How big of a jump here? Here we can see that implied volatility just spiking, right? Post-earnings as the stock ripped higher here. Here you can see I went out to the 120-day IV, but it moved across the spectrum. As you can see here, 30-day IV certainly jumped higher as well, all the way the term structure vol lifted everywhere as far as that. You can see here are the different expiration dates, the big spike in implied volatility. Again, this is post-earnings. Normally you see that vol crush, right, which we saw here going from 97-ish, right, to 77-ish. Then with that big option volume coming in, especially on the call side, IV spiking, basically almost doubling, as we said, up over 80%, simply because of that big call buying coming in. Here, a different look at it, taking a look at basically the puts and calls that are slightly out of the money, 30-ish delta, right? And you can see IV pretty constant here, had the little spike pre-earnings, then the traditional kind of dump, and then that pump, right, based on that unusual option activity, some of it having to do with the fact that the stock is hard to borrow. You have to pay about a 50-ish% cost to borrow it, so difficult to borrow. They are starting to attack some of these meme manias, similar to the GameStop holdings before, right? We'll see how long lasting that is, but certainly with SPCE, saw a huge spike on Friday, as we'll see in a second. So that short interest, certainly a reason. Perhaps you saw this huge spike in call buying and implied volatility, but sets up ideally for several big vol capture trades. So here's a January straddle went out going back to May 8th, right, and taking a look at the January 5 straddle, right? The stock was at 285. January 5 straddle puts trading, about $2.70 or so. The call is basically just at a nominal value. That straddle trading a little bit under $3, $2.90-ish or so, with the puts pretty much at parity. The calls trading at a very, very nominal value. The day before, that big option volume that we saw, right, the stock was at 355, right? We can see that that straddle, that January 5 straddle, right, closed at about $2.85. Here you can see here the stock at 355, Jan 5 straddle at 285. The IV basically blended between the call and the put, right? And the put's carrying a higher IV because the stock is hard to borrow, right? So because of that, puts carry a higher IV than the calls, simply because buying puts is a synthetic kind of short stock. You can avoid that borrow cost if you wanted to short the stock, or if you could short the stock, right? And the trade was certainly in the money, right? That $5 straddle, the $5 put in the money by $1.45, the call out of the money by a decent amount. And you can see the delta, if you would have sold this straddle, about 11. Note too that it doesn't equate to the normal 100 delta relationship, right? By selling the put at a negative 44, right, and then selling call at a 36, right, you'd only get a 80 delta. Why? Because that implies the cost to borrow the stock, right? So the delta relationship is a little bit skewed because of that hard to borrow, that borrow cost on the stock. But let's take a look then at the straddle on Friday's close after all that big call buying, right? We can see the stock did move higher to $4.80, as we can see here, right? So the stock closed at $4.80, and we see that straddle jumped to $3.56. So the straddle, which the day before had closed under $3, right, actually closed over $3.50, even with the stock price moving towards the ideal strike is 5, right? So moving from 350-ish to 480, still out of the money on the call side, in the money on the put side, but a very beneficial move being short the straddle. But because of that huge jump in implied volatility, now the IV at almost 120. The day before we saw was under 100. That straddle price actually increased by well over 50 cents. Why? Because that big option buying, especially on the call side, as we saw earlier, just simply made the price of the option skyrocket. Interesting to note too, the delta, right? Because of the borrow cost actually going up a little, the deltas get skewed as well. Even with the calls out of the money, the puts in the money, selling that straddle, you would have been short 37 deltas, right? You'd be bearish a position. Normally, if the stock, if you could borrow it, right, and if IV wasn't that high, it would certainly be a slightly bullish or almost flat trade. Another trade to look at is the October strangle. Here again, it's before that big call buying out there. We can see the stock once again at 355. That October 4-6 strangle, selling the $4 put, selling the $6 call, right, close at about $1.44 before the big call buying started, right? We can see the puts, right, were slightly in the money. The $4 put with the stock at 355, slightly in the money, right? The call well out of the money, and the net delta on that at inception, right, right around 30, right? The IV, the combined between the call and the put, just around the 88 level. Then after that big option buying, we can see the stock at 480, which is ideal, right? In between the $4 put strike, right? 80 cents above it, and below the $6 call strike, $1.20 below it. So the puts are still close to the money, but that strangle actually jumped to over $1.80 from just over $1.40. Why? Because that huge jump in implied volatility to 112. Remember, before it was under 90, now it's over 110. So that big jump in implied volatility makes this trade jump by about 40 cents, which on a $1.40 trade is a very nice move. So this would be another way to sell the strangle, capture that implied volatility pop in a neutral fashion, and then just wait for the IV, which we expect, certainly, given that huge spike we've seen, to revert back at some point, right? You can take a look at it too. Here, this is the highest IV basically has been over the past year, all because of that big unusual call buying. And then probably one of the most interesting trades, right, is that October straddle, right? The $6 straddle. So here it is again before the big call buying with the stock at 355, right, on May 15th or May 14th close, right? You can see the OX6 straddle closed at about 305, right? The call's basically about worthless, trading about a dime or so. The puts, right, are going to be worth somewhere around that, 255-ish level, plus a little bit of that cost to borrow, right, premium, right? So the straddle trading just around $3, maybe a touch over. The IV blended, right, about 88 again. And the delta on this one, because you're deeper in the money, you definitely be bullish even with that hard to borrow kind of lowering of the put delta, but you definitely would have been in the money as far as on the put side deeply, which makes the delta for selling the put and the call, which the call well out of the money, having a very small 15 delta, the put about a 66 delta, so you'd be net long about 50 deltas. Fast forward to right after that big unusual option activity, the stock again moved to 4.80, right? So moving towards 6, but certainly not even getting above it or anywhere near it, really. But you would expect, certainly with that kind of move, from about $3.50 to almost $5, right? The $6 straddle price to drop, nope, went up in price to $3.40. Before it was just a little bit over 3. Now we're looking at well over 3. Why? Because of that UOA ripping that IV higher, right? We saw that IV just explode here. So that October straddle now increased in price, even with the stock moving, but not really going through, right, that $6 straddle level, right? And even with that move and with the hard to borrow, it would have been a neutral trade. So you're bullish to begin with, ended up pretty neutral. The stock moved in your favor by a huge amount, by about 30-some%, right? But yet that straddle got more expensive. Why? Because of that big jump in implied volatility. So this is what we look at day in and day out here to take advantage of big unusual option activity, always taking a look at implied volatility, putting implied volatility pops and drops in our favor, find the edge, then put on the edge. Will the trade work out? Who knows at the end of the day, but putting the probabilities in your favor, in our opinion, always a very, very beneficial thing, because at the end of the day, trading is all about probabilities, not certainty. So we'll let you know how this one turns out. Take care.